You call your bank. First, the automated voice answers. Then the menu. Then the hold music. Then another message telling you, your call is important. But somewhere else, another customer calls the same bank and reaches a human faster. Same bank. Same logo. Same system. Different treatment. Not because they are kinder. Not because they are luckier. Because somewhere inside a database you have never seen, their name sits beside a better number. That number decides how fast someone picks up the phone. Whether a fee gets waived, whether an overdraft gets forgiven, whether a banker calls back, and whether the bank sees you as a relationship or just another account. You never applied for this ranking. You were never told your tier. But it has been calculating you since the day you opened your account. And the most uncomfortable part is this. Your bank may not know who you are, but it knows exactly what you are worth. Level 1. The cost center. You walk into a branch with a simple checking account and a balance that barely clears 3 figures. The teller is polite. The wait is long. Nobody mentions a relationship manager because you do not have one. Here is the mechanism. Banks evaluate accounts through internal profitability and relationship value models. Manual teller visits, paper statements, phone support, fee waivers. These all show up as overhead. A standard retail account with light balances and heavy in-person service tends to land in the bank's least profitable category. Low revenue. Real cost. The uncomfortable truth is that you are not being underserved by accident. You are being served at roughly the level your balance justifies. No more. The bank is not being cold, it is being mathematical. At this level, you are not a customer. You are an expense the bank tolerates while it waits to see what you become. But somewhere, a number is already moving. And the moment it crosses a line you do not even know exists, the bank changes how it sees you. Silently, your balance crosses $30,000. At Citibank specifically, this is the documented line where you enter Citi Priority, a named tier with its own fee waivers and benefits. You have crossed a documented threshold. Even if nobody fully explains what it really means for how you are being tracked. The mechanism here is householding. The bank's CRM software links eligible deposit, retirement, and investment accounts tied to your customer relationship into one combined balance. You are no longer one account. You are a relationship value the system is starting to track in real time. The uncomfortable truth is this. You are not being rewarded yet. You are being watched. The system has flagged you as someone with growth potential. And every transaction you make from here is data feeding a prediction about where your money is headed next. At this level, you are not valued. You are being measured for what you might become. What happens next is not subtle anymore. At a certain balance, the phone calls start. And what they are really calling about is not service. Cross $150,000 in linked qualifying deposits and investments at Chase, and you are moved into Chase Private Client. Cross $200,000 at Citi, and you are in Citi Gold, with lounge access and annual subscription credits. Bank of America's relationship rewards programs have offered balance-based benefits, including credit card rewards bonuses and fee-related perks. The exact percentages and tier names have shifted over time. But the principle holds. The more you keep with the bank, the more it pays you back. The mechanism is simple. At these thresholds, your relationship revenue starts to clearly outweigh your cost to serve. Interest margin, card fees, advisory potential, future loans, future investments. Now the bank's CRM software is actively prompting your assigned banker to reach out with a recommendation. A mortgage, a managed account, an investment product. That does not mean every recommendation is bad, but it does mean every recommendation has to be judged against the bank's incentive to earn from the relationship. At this level, you are not protected. You are being cultivated. But cultivation has a ceiling. past a certain point, the bank stops trying to sell you things, because you have become too valuable to risk losing. Cross $1 million in qualifying assets, and Schwab automatically enrolls you in private client services. Maintain $1 million or more in combined average monthly balance at Citi, and you stay inside Citigold Private Client, where wire fees disappear. At institutions like Wells Fargo Private Bank, higher net worth clients may receive dedicated planning and advisory support. You stop hearing about products, and you start hearing about strategy. The mechanism is the shift from transactional banking to relationship banking. The bank now calculates your projected long-term value, not just what you are worth today, but what you are likely worth over years, weighed against the cost of keeping you happy. The uncomfortable truth is this: even here, grace exists only because you are profitable enough to extend it. Citigold allows your balance to dip below the threshold for a period before the system moves to retier you. The kindness has a clock on it. At this level, you are not a person to your bank. You are a forecasted revenue stream with a name attached. There is a level above this where the bank does not just protect your money. It builds an entire division around people like you. Most accounts will never see what that division looks like from the inside. Past roughly $5 million, you stop being a retail customer entirely. Morgan Stanley moves you into private wealth management. Goldman Sachs Private Wealth Management is generally associated with very high net worth and ultra high net worth clients, often reported around 8 figures in investable assets. JP Morgan Private Bank is commonly reported to serve clients around the multi-million-dollar level, often cited near $5 million or more, though exact eligibility can depend on the relationship. The mechanism is this. At this tier, the bank is not servicing an account anymore. It is managing a portfolio of fee-generating assets under management. Every percentage point becomes recurring revenue. You are no longer evaluated by a teller or a branch banker. You are evaluated by a wealth advisory team, with client ratios reported to run as tight as 1 advisor for every 25 families. The uncomfortable truth is that the richer you get, the more the institution can potentially earn from keeping your assets under management. At this level, you are not banked. You are managed. But even at this level, there is still a ceiling above you. One you cannot apply for. One that does not show up in any brochure. Because it is not meant to. Somewhere near the 8-figure mark, something happens that is rarely confirmed on paper but widely reported by those close to it. An invitation. JP Morgan's Reserve Card, a heavy metal card widely reported to include palladium and gold-plated elements, is widely reported to be reserved for private bank clients holding assets at that level. The bank has never published an exact public eligibility number, and that ambiguity is itself part of the design. Exclusivity that cannot be looked up is exclusivity that cannot be gained. The card's real value is not only transaction revenue. Its deeper purpose is symbolic. Retention, exclusivity, status inside the relationship. A physical confirmation that you have reached the top of a hierarchy most account holders will never see exist. The uncomfortable truth is this: the card is not the reward. The card is proof that the system worked exactly as designed. It found you, ranked you, courted you, and finally marked you as someone worth keeping permanently. At this level, you are not a client. You are the proof of concept the whole ranking system was built to produce. None of this required a hidden conspiracy. It required spreadsheets, a profitability model, a household database, and a quiet willingness to treat every customer as a number until that number proved itself wrong. The branch smiled at you the same way either way. Only the database knew the difference. And now, so do you. The goal is not to impress the bank. The goal is to build enough leverage that the bank can no longer afford to ignore you. If you want to understand the hidden rules of money, stay with this channel.